Hello, Buran community. Happy Thursday to all of us. I hope you and yours are doing fantastic and welcome to today's community session on YouTube. I'd like to start with this session with a statement that says the blockchain technology is the future on-chain monetary system. This is a very important statement and it's a bold statement. And as always, we don't like to just make statements like that, but we'd like to verify them, put them to a test. And I'd like us to hit two birds with one stone in this session today, as I would also like us to look at something else in addition. But since we are on CoinMarketCap, let's just briefly go through it. We are down just about 2% for within the last 24 hours. And right now we are sitting at 29% in terms of fear and greed index. Even though we just had a rate cut yesterday. So what's going on, right? So I started with the statement that blockchain technology is the future on-chain monetary system. This implies that blockchain technology is going to present us with a new monetary system. History shows us that in order for something new to be implemented, the old has to break. So let's keep this in mind as we progress throughout this session. And like I also suggested, I'd like us to also hit two bats with one stone. So I'd like to add this statement as well. We all are very familiar with this individual, Tom Lee. I'm not going to even bother playing it, but I'm going to link exactly this this video, this link. It's on X. I'm going to link it in the video description below. So just scroll down to the description, and then you'll be able to play it. I'll provide the link to this, so you'll be able to tune into the audio. However, let me summarize what is said here. So we are all familiar with, most of us are familiar with Tom Lee. So he says that he's predicting 100,000 Ethereum, right? And says this is the number one mistake he sees in new Ethereum holders, right? And these are the mistakes that new Ethereum holders are making. What they're doing is they're looking at Ethereum's price and they're looking at it and in regards to what's happening today, right? Short term, what's happening today. And they miss the fact that Ethereum is the future. And he's urging individuals to invest in that super cycle that is heading towards the future. And he further says that what he thinks people get wrong is literally Ethereum. They get Ethereum really, really wrong. And it still got 100,000 price in the future. So the point of this video is not to speculate and look at the price. That's not the point. The point is right here, what people get wrong in Ethereum. And this is to also goes hand in hand with the statement that we made that the blockchain technology is the future on-chain monetary system and the solution to so many challenges we are faced with in the traditional world. So with that said, these are bold statements that we just made. And it's time to now look at them and use facts, articles, public information to verify the facts, the statement that we just made at the beginning of this session. Again, blockchain technology is the future on-chain monetary system. And let's verify this as well. Is Tom Lee right saying that with this statement, saying that a lot of people that are making mistake in looking at Ethereum is they're looking at what's happening now, today, but they miss the big picture that Ethereum is the future. What makes Ethereum the future? And how can we make the most out of this, the super cycle that is yet to come and ahead of us? What does that super cycle look like? In addition, why do large markets create artificial demand and volume? Why and how do they create artificial demand and volume? Why do they use that to inflate markets? All sorts of industries. All of these questions, community, we're about to dissect, analyze, and get to the bottom of them in this session today. So let's get started. And there is no better way to start than to, first of all, understand what are the challenges, what are the potential black swan, so-called black swan events, right? So first of all, I'd like to bring to our attention that there are 3 black swan events, right? And again, everything I say them are personal opinions, just connecting the dots and just sharing my opinion with the public, right? So in order for something, like we said, in order for something new to be implemented, the old has to break. And it has to break not in a regional setting, but on a global scale. So this tells us that this month is literally going to be a transition, right? December this year, more than ever, is a month of pure transition. Transition from what? Transition from how the current system is put together into how a new system is emerging and starting. So it's like we're in the middle of the bridge about to cross, leaving the old behind and embracing the new that is still ahead of us. And this doesn't mean that it's going to happen this month, everything at once, but it's going to kickstart it. It's going to set it in motion. Definitely, that's taking place as we speak. So right now, as we know, the crypto industry is the youngest asset class right now, and thus, hence, it's very speculative still. It's very speculative, but nonetheless, not just cryptocurrencies, but also technology sector as well, rare earths, and so on and so forth, declined, right? Started declining. And why was that the case? Lack of liquidity in the markets. So the market went from euphoria to acute, right? And we also saw that NVIDIA, being the largest stock and company based on market cap, even though they posted high numbers, it was followed, the next day was followed by a sell-off, right? And because of rumors that inventories and credit were not matching up. So the creditors had not paid them and they were still waiting for the payments to come in. But that's a whole different story. So the whole takeaway I want us to have here is that we are going through a transition right now, right? And it started in December. This month is going to, end of the year is a month of pure transitioning from the old into the new. So now there's a rally in the US, right? And worldwide. And this rally affects the stock market and is seemingly dependent on the success of no more than 4 or 5 companies. So the whole US rally and the rest of the world, worldwide, depend on a handful of companies. Which are they? They're the big AI tech companies. And before we name them individually, the 3 big swan events that we're looking at, community, is going to be the bond market, the stock market, the AI market. But we'll get into the most important one, the biggest one, is where the liquidity itself comes from, and that's from the Bank of Japan. But let's go through it step by step. So first thing is these big tech, AI big tech companies have transformed into the main source of growth, as well as providers of liquidity. Keep in mind, this is not just in the US, but worldwide. So 70% of the global liquidity, global wealth, ends up in a handful of companies, 4 to 5 companies. And these 4 to 5 companies are big AI tech companies. And these big AI tech companies are the ones transforming, and the main source of growth in the stock market, in the AI market, in the bond market. They're the ones, right, that provide the providers of liquidity. And how are they doing it? Through buybacks. We'll get to this step by step. And community, this is very important to understand, because keep in mind, we're answering the question, how is it that Tom Lee is saying that the way we approach and we look at Ethereum is wrong? We shouldn't be focusing on it now, but we should look at it as the future, because in the future, the blockchain technology is the on-chain monetary system. Okay. Also, we are addressing the question of the statement that why are markets, large markets, artificially inflating or causing, artificially using artificial volume and to inflate the assets? This is what we're looking at. So what we're looking at here is now through buybacks, these big tech companies that are literally the source of global wealth ends up in these 4 to 5 companies. And what they are doing is they're providing liquidity to the rest of the markets through buybacks, by buying back their own stocks. And never has there been so much capital returned to its shareholders in the history. In the history of finance, never has so much capital been returned to its shareholders. And among these companies, like we say, a handful of them, Microsoft, these are the big AI companies. Alphabet, known as Google, Meta, Facebook, Amazon, and NVIDIA, right? And now these are the big AI companies, but also these 5 are also part of the Magnificent 7. So they represent the AI, tech, and also they represent the Magnificent 7 in terms of stock market as well. So now the challenge here, community, is that the spending of these AI companies is increasing very fast. And some people, including ourselves, are already asking when these companies will start making a profit, because none of these are making any profit. They've been spending hundreds of billions of dollars for many years. However, none of them is showing any profit from their investments. So in other words, when is the tipping point going to be reached? And when is the bubble going to burst? So this is one of those big black swan events that we're looking at. And this represents both the AI and the stock market as well. And then we're also about to look at the bond market, which is the third one. But as we're still here, let's not just take this article for its face value. Let's look at what it really means. What do they mean that through buybacks, they're providing liquidity, right, to the rest of the market? So let's make an example. Let's take the first one, Microsoft. So if we are to take Microsoft, I'd like us to look at something. Here is Microsoft. So if you come to Yahoo Finance and you just search for Microsoft, and then you go down to holders, and you scroll down, you'll realize that, first of all, 75% of shareholders are institutions. So that alone should tell you they're feeding to themselves. So, and who are the largest shareholders of Microsoft? Are the asset managers, the Vanguard, the BlackRock, the JP Morgan, State Street. These are all the largest asset managers in the world. These two alone are the largest, hold close to 18%, right? Actually 17%, over 17%. Actually, if you add JP Morgan, the top 3 hold 20%, over 20% of the shares of Microsoft. What does this mean? First of all, these are asset managers and banks. So remember, what we're saying is that never in history have we seen these stocks, these companies doing buybacks and giving so much back to their shareholders. So the irony of this is we need to see who are their shareholders. And we realize that Microsoft shareholders, NVIDIA's, Meta shareholders are mainly asset managers and banks. So whenever they're giving back by doing, they're rebuying their stocks, they're giving back to the asset managers and the banks. And then the banks in return, the asset managers, what they do now is with their revenue, they're buying even more of that stock. And if they buy more of that stock, the stock prices increases. And then the profits of the stock price that increased, in this case, Microsoft, they're doing buybacks again. And this is how they're creating that artificial volume and artificial demand. And this is how they keep inflating their own stock. And it's just a repetitive period that is going on, producing this main growth. And the liquidity comes from the world, US and the worldwide, comes into this handful. So that seemingly depends, a stock market, the entire stock market depends on a handful of companies. This handful of companies are mainly big tech companies and part of the Magnificent Seven. And we'll get to where they are getting their liquidity from. But once they have it, they do buybacks. When they do buybacks, this growth goes, they provide liquidity. And never in the history has there been such a period where so much capital is returned to the shareholders. Who are the shareholders of these top 5 largest tech companies? It's asset managers. And these asset managers are being given back. This capital goes right back to the asset managers. And these asset managers are also buying even more of these stocks. As we saw, this is why they are the majority shareholders, as you can see. This is Microsoft. And who owns majority of them? Asset managers. Why? It's because they keep artificially moving this liquidity, this funds, this volume amongst themselves and moving it around amongst themselves. So this is what we made the statement at the very beginning. Why do markets create artificial volume and demand? It's because there's a broken system. A broken system is debt-driven. A broken system depends on increased debt. And increased debt means inflation. And how that works, community, is that we realize that liquidity doesn't come from goods and services produced, but liquidity comes from something known as the Bank of Japan. And we'll get to that. Before we get to that, let's look at Vanguard or BlackRock. Let's look at BlackRock, for example. Let's look at BlackRock. If we come over here, let's look at BlackRock. So if we come to BlackRock, community, let's go to holders. And of course, 83% of BlackRock shareholders are institutions, so even bigger. And surprise, surprise, they are holding themselves. So largest holder of BlackRock, this is BlackRock, right? Who are the largest, three top largest holders of BlackRock? And among the top holders is BlackRock itself. So we see how BlackRock is buying their own shares. They themselves are doing buybacks and giving back to their shareholders. Who are their shareholders? Their competitors, Vanguard, State Street, other asset managers, and banks. So this just proves the point that even BlackRock is doing buybacks because they are the second largest holders of their own stocks. How does that make sense? How can you be the largest holder of your own stock, the top 2 largest holders of your own stock? If we go to Vanguard, Vanguard is BlackRock's largest holder. And if we were to go to Vanguard right now, just to make a point, if we were to go to Vanguard right now, we would see that it is literally Vanguard that let me see, Vanguard. We'll realize that it's Vanguard that is BlackRock that is actually the largest holder of it. So now let's go to where do they get their liquidity? Where do they get the liquidity? So here it shows us again that it's the bond market, the stock market, and the AI sector. These are the sectors that were trembling because, and the entire US stock market and NVIDIA declined because panic mounts around the Japan's bond market, right? The bond market implosion. So we just saw the fact that these 5 top tech companies that are AI heavy are actually providing liquidity by literally purchasing their own, doing buybacks of their own stocks. And as they do that, they give back to the shareholders. The shareholders are asset managers. Asset managers also buy back their own shares and give back to their shareholders or other asset managers. And then combined, they go back to the stocks and buy these stocks again, pushing their stocks prices up. And these stock markets, as they get profits, they in turn also do buybacks, and so on and so forth. So now, where do these get their liquidity from? They get it from the Bank of Japan through the bond market, the Japanese bond market. But now, why is this such a disaster now? Is because for many years, right, the bond yield spiked after many decades. There's been the US bond market, the Japanese bond market has been to near zero interest. So what has been happening is that this massive increase in the bond yields it's what warning to the US government if they do not resolve the deficit spending crisis, because the liquidity is coming from the Bank of Japan and is going over to US assets. So this is why what's happening in Japan through the Bank of Japan that kept its interest rate near zero and allowed global players to borrow cheap yen and deploy it somewhere else. The somewhere else is what we've been discussing about for the last few minutes. It's the US market, the stock market, the bond market, right? Like we just saw here, and the AI sector. So this is exactly what it's about. So the bond market, the stock market, the AI sector is financed by zero interest, right? Kept near zero interest from the Japanese yen, right? And this is exactly what's known as the yen carry trade, and was one of the strongest liquidity vehicles for financial markets, global financial markets. So now we get to the mother of all of this. This is where the liquidity comes from, where the world is literally inflating assets in the US, the stock market, the bond market, and the AI sector, right? So, but now the challenge is Japan is now facing rising inflation. And they're weak, obviously, with because it's under a debt-driven monetary system. The more debt you incur, the more inflation you get. And more inflation you get, that weakens your fiat, meaning your purchasing power decreases. So now, because of all of this, we realize that there is the crisis that we're looking at right now is the debt crisis, like we said. This monetary system is debt-driven and it's not sustainable. And it depends on 2 major things to run. It depends on low interest rate, near zero interest rate, like we just seen. So, and also, it also depends on unlimited liquidity. And this is exactly what Japan, the Bank of Japan, has been providing. It's been providing. So this is exactly what we need to understand. So this is the takeaway from here, is that these 3 sectors right here, let's go back to it. the bond market, the stock market, the AI sector, like we just discussed in the US and worldwide, are being artificially inflated, and liquidity is provided by receiving near zero interest rates from Japanese bonds, right? Near zero interest rates, and then deployed somewhere else, right? Allowing global players to borrow cheap yen and deploy it somewhere else. But now, because the yen is going up, like we're about to see here, we realize that the real threat are not the markets themselves, but the real threat comes from the Bank of Japan, because they're the ones providing liquidity for all this inflation to take place, all these buybacks of these large tech companies, all these buybacks of all these asset managers, and the entire stock, bond, and AI sector is financed through the Bank of Japan, through the near zero interest rates that is cheap money, unlimited supply, and limited liquidity that is literally inflating the markets in the US. And this is the real black swan event. Remember, we're talking about, if we want to come in with the old, with the new, the old has to break. And these are the three so-called black swan events, community, that we can look at, that are when it breaks, it's going to make room for a new system, and that system is going to be the blockchain technology, and it's going to be the on-chain monetary system that is more sustainable, more inclusive, more efficient, more transparent, more decentralized, and more sustainable, and more liquid, and away from inflation. And this is exactly what this system is all about. So first of all, let's understand the challenge we faced with. What is a carry trade? So let's understand what Bank of Japan's situation is right now, what it does for the rest of the world. So a carry trade is a type of foreign exchange trade in which you borrow money in one currency at a low interest rate, right? Like we just discussed, and use it to make high interest investments in other currencies, right? So as the name suggests, in a Japanese yen carry trade, the currency you borrow is in the yen, right? But let's look at it even closer. So a currency carry trade occurs when people borrow in one currency and invest in another country. For example, suppose Japanese interest rate are 0%, which they've been for the last 30 years, like for decades and decades, near zero interest rates. And US interest rates is at 5. So in this case, an investor can buy the yen and borrow from the Japanese bank at 0%, and then go over to the US and buy all these big tech companies, bonds, stocks, right, with zero interest, and earn, if it's the bond market, 5%, if it's the AI sector, even more, if it's cryptocurrency, if it's whatever the case may be, the stock market. And this is how, through Japan, the world has been literally inflating the US markets, and precisely a handful of companies, 4 to 5 companies, like we just discussed for the last few minutes. So this is the situation. This is the challenge we find ourselves in, community. This is exactly the challenge we find ourselves in, because now this situation, this so-called yen carry trade, is literally threatening the global markets. It's not just a challenge that US is faced with. Actually, the whole world is faced with, because global wealth, 70% of global wealth, is literally depending or lays in the hands. Let's go back here. The rally of the US stock market and the worldwide is dependent on the success of no more than 4 to 5 companies. This is a reality. That's Microsoft, Alphabet, or known as Google, Meta, Amazon, and Nvidia. So the global wealth ends up in here. And these 5 companies, they're the largest liquidity providers. Why? How are they doing it? Again, through buybacks. And the largest shareholders, like we saw, asset managers, they are, once they get their capital returned to their shareholders, they in turn buy even more of these stocks. And then that's how they create this artificial demand and volume. And all of that liquidity, like we just said, comes from the Bank of Japan, which formerly you were able to use or borrow at 0% and then come over to the US and indulge yourself in purchasing all these US assets, whether it's bonds, stocks, cryptocurrencies, or the AI sector. So this is the threat, the global threat that is we are faced with right now. And next week, the Bank of Japan is planning on even increasing the interest rate even further. And once they do that, let's go back here. So the Bank of Japan to hike rates to 0.75 and in December, but then to 1% by next September 2026. So now the luxury of 1% interest rate or 0% interest rate is gone. And now where they used to borrow at 0% interest rate in Japan and get high bonds rate in US, the US is also now cutting the interest. And because of that, there's not much liquidity available to pump the stock market, the cryptocurrency market, the bond market, and the AI sector. And this is exactly where the challenge is right now. This is why you see the market so volatile. And this is exactly the situation we find ourselves in right now. And this is the transition that we're looking at, because the transition now, community, is while the Bank of Japan has been for decades the world's ATM machine, literally. Now, by using Japan's zero interest liquidity, artificially pumping global markets with it. Meanwhile, Japan has been faced with inflation, devaluing of the yen, and while the global financial markets have been inflated, their assets artificially. So what's happening now, as the Bank of Japan's interest rates are going up, making access to liquidity more and more expensive, it's not an attractive investment anymore. So now they're looking for new ways, how, where to invest in. Meanwhile, the US is doing the opposite, or working on doing the opposite. They're bringing their high interest rates, trying to bring it down, actually down to zero based on Trump's suggestions. And once he puts in place his personally elected new Fed chair, they'll want to bring it down to zero. So this is the transition that is playing out in front of our eyes, community. We're seeing a situation where we're seeing a change of the guard. And with the US, with Japan, they didn't have a sustainable system because they're not using, or they were not in the use of blockchain technology that is going to literally save them and make it sustainable. But the US now has no other option but to embrace this blockchain technology. And they've done so by simply going through the regulations and passing it through and offering the Genius Act, through the passing of the Genius Act, right? What I want us to look at again here is that the carry trade, it's unwinding. This is a global crisis that will be, it will have such a huge implication of the rest of the world. And this is something we need to really pay attention to. So again, Japan used to have a prolonged period of ultra low interest rates, and it made it a hub of so-called carry trade, where investors borrow in low yielding yen to invest in higher yielding assets outside of Japan, right? However, with the Japanese yields now rising, this strategy becomes less attractive. It's not attractive anymore, right? And it's now, that's what you call carry trade unwinding. So this reversal can lead to a significant capital flows back into Japan. And this causes a sell-off in global markets. So there'll be sell-offs, specifically in the US markets, the stock market, the bond market, the cryptocurrencies market, the AI sector, and particularly in currencies and equities. Equities is the stock market. So the thing is here, the carry trade, like we said, is investing strategy that involves borrowing in a currency with a lower interest rate and buy an asset in a higher interest rate, right, in return. And where it takes place the most is investing in bonds, stocks, commodities, or other assets, right? That's exactly where it takes place. And all of these are leverage. Investing using borrowed money can also be used to in practice, right? It's for strategy. And there's a massive amount of leverage being exploited. So imagine you're taking a loan to invest in a volatile asset. And once that asset starts crashing, because after the bear market, everything starts going down, right? And once that takes place, don't take my word for it. Let's look at this article. Most protocols crash 50 to 90% in bear market, right? This is like common. They crash. And once that starts taking place, liquidations take place. And now you can't afford to pay back the loan from the Bank of Japan. And you get liquidated there as well. So you see like that cycle. Now, here we are on chain. So these things don't just happen in the traditional world, but it can also happen on chain with decentralized financial products. So yield farming are stakers, those who are staking today. So staking today is broken. This is what they mean. Why do they say it's broken? It's because once liquidity dries out, when bear market comes, there's a crash of 50 to 90%. So this is why we always stress on address the four challenges. One of the four challenges is liquidity. So once liquidity is being taken out of the markets, you crash. So this is why you have to ensure that your ecosystem retains it. With every trade, buy and sell, make sure that you retain liquidity. Make sure that you keep away from inflation and are deflationary, if not scarce, preferably. Also, make sure that the rewards you give out to these stakers, these so-called farmers, doesn't cause inflation. So in our case, our staking platform, Bullrun staking platform, gives you a stable coin, not BRL tokens. So these are the reasons why. And then the final one is using your volume efficiently. So use your high volume efficiently, because that volume is supposed to be accumulating liquidity so that during a bear market, you don't crash that much. There's enough liquidity. Ensure that you have a sustainable staking rewards, staking distribution, so that individuals can remain staked, because during the downside, people fear downside risk. And this is why they just get back into their stable coins and then they just sit on it. They sit idle because the people fear downside risks. So if you have deep liquidity, if you have a high staked percentage of your ecosystem token, if you are deflationary, if not scarce, you're causing a better environment than stablecoins. So now instead of individuals going to stablecoins, they're going to come to, in our case, for example, to a staking platform that is scarce, doesn't cause inflation, giving out its USDC distributions, is accumulating liquidity. So, and as you stake it, you receive even more USDC distributions. So instead of just sitting idle on a stablecoin because you're afraid of the down risk, it gives you an option where you can sit on BRL, staked BRL, as you receive your USDC distributions, as the volumes are passing through. And during the bear market, that's when you realize that you were better off having an ecosystem that was retaining liquidity. This minimizes the crash because it gives confidence to the stakers and to the traders alike that there is enough liquidity, there is sustainable staking distributions, and the volume is being used efficiently to cause deflation, if not scarcity of the token. So this is exactly what we're looking at. So stakers face impermanent loss, liquidations, and even zero yields when volatility dies. Volatility is liquidity. When liquidity dies out, the bear market sits in, there's a crash. So during an upside, during this super cycle that Tom Lee was talking about earlier, you want to be accumulating liquidity, retaining liquidity, accumulating USDC distributions, banning your supply, and using your volume efficiently so that you are prepared and you're addressing these challenges right here, right? And this is what our Boron ecosystem is doing. So now I'd like us to look at something else here. The only option, if you have a monetary system in place that is not sustainable, that is debt-driven, a debt-driven monetary system, that only works through a combination of low interest rates and access to unlimited liquidity that literally cause inflation, loss of purchasing power, increased debt, and is an unsustainable monetary system. It's not going to work. And now this is where Ethereum steps in. And this is where we see that transition we've been talking about. Now that we've discussed the black swans that will lead to the acceptance of a new monetary system, we discussed the black swans. Now let's look at what's going to take place. So the SEC chair came out saying that within the next 2 years, the entire US markets will be on-chain on Ethereum. He came out and said it because majority of stable coins, real-world assets, tokenized assets in general, commodities even, ETFs, tokenized ETFs and all that is going to take place right there on Ethereum. Visa, MasterCard are building rails, payment rails on Ethereum. JP Morgan has its collateralized network, tokenized collateral network, also on Ethereum built on there. And JP Morgan, BlackRock already, they have their BUIDL token, which is tokenized US Treasury bond, also on Ethereum. And now with all this tokenization of assets, how is liquidity going to be provided for all these tokenized assets? Is through stablecoin. And which is the number one most denominated stablecoin? Is in what denomination? It's in US dollars. So imagine this is how liquidity is going to rush onto Ethereum. So you see how the commodities futures trading has piloted with Ethereum as collateral for the US derivatives market. We'll get to this. We'll get to the derivatives markets. Let's get to BlackRock. They are filing for staked ETH ETF. So you realize that why is everything coming together like this so beautifully? And you see how all these large institutions are working together. SEC is a US agency. This is another agency. And this is the largest asset manager in the world. Why are they all using Ethereum? Because Ethereum, which represents the blockchain technology, smart contracts, proof of stake network, is the largest one, is literally the home of the next on-chain monetary system. And you won't have to go to Japan to get zero liquidity because the US right now is in the process of lowering their interest rates to zero. Meanwhile, because this on-chain tokenization that is taking place on-chain, all these tokenized assets, stablecoins are going to be required. Stablecoins are going to be required to back their stablecoins with US bonds. So now there'll be a transition from Japan to US because now US will be the one with a low interest rate, near zero interest rate. And there'll be a high demand for US bonds because the stablecoin issuers that will have to issue a lot of stablecoins to be able to be paired with all these tokenized assets that are yet to come in the quadrillions of dollars. Why am I saying quadrillion? Because the derivatives market. Let's look at how large the derivatives market is. How big is the derivatives market? That's the question. The derivatives market, in one word, is gigantic, often estimated over 1 quadrillion. So we are talking about a lot of liquidity that is about to hit one specific blockchain in particular. And this is why it's so important to understand what's happening here. Because what's important to these large Wall Street institutions is they don't care about speed. They want credibility and neutrality, decentralization. They want uptime, 100%, not 80%, not 60%, 100% uptime, and reliable, and also finality of the transactions that are, once they go through, it's final. And the only place, and that's why almost every serious bank is building on Ethereum, because Ethereum is the only, and I use the word only, layer one blockchain with 100% uptime. There is no other, not even close. That means it's reliable, it's secure, and this is what brings credibility, right? And this is why you see all these large banks, global banks, including the entire Swiss Bankers Association, they're using Ethereum blockchain technology. The government of Switzerland is offering Ethereum staking already to its residents and citizens. And now finally, to make this even sweeter, the SEC, the Security and Exchange Commission Chair Paul Hodgkins already said that initial coin offerings tied to network tokens, in our case, Ethereum. So tokens on Ethereum, for example, in our case, or digital collectibles, which are NFTs, or digital tools, which are applications using smart contracts. So any initial coin offering tied to network token like Ethereum with NFTs and applications should not be treated as securities and do not fall under the Security and Exchange Commission purview. So meaning that they are good. They're giving, the SEC itself is giving green light to companies, institutions to do initial coin offerings that are tied to Ethereum network, NFTs, and other utility applications, and will not be treated as securities. All of these, let's go back to where we started this session today. All of what we discussed is just summarizing what Tom Lee was actually saying at the beginning, and we were able to verify it. So if you look at Ethereum as of today, if you just focus on its price today, you're going to miss the big picture, because Ethereum is for the future. And we are going through a transition right now from the old to the new. And the old is outdated, it's debt-driven, it's unsustainable. And the new is the new technology on-chain. And in order for the new to be embraced, the old has to be put to rest, right? And the way to do that is with these three black swan events that are potentially going to take place. Because like we just saw that with the Bank of Japan unwinding its carry trade, and they are the large providers of liquidity, and this liquidity is in the hands, depends of the success of these 4 or 5 companies. These 4 or 5 companies are not getting any liquidity anymore because it's not as cheap as it used to be. And now they used to do buybacks because of the success. And they were returning this capital to their shareholders, which were asset managers. And these asset managers in turn came back to buy back these stocks, and creating this feedback loop that is artificially inflated. That's the situation we're in right now. But what does this mean? What does all of this mean to us as a community? It means that it's just telling us that if you want to make the most out of this cycle, this super cycle that Tom Lee was talking about here, you have to be able to address the 4 challenges. You have to be able to be part of a solution, not part of a problem. You have to be addressing inflation. You have to be addressing liquidity challenges, sustainable staking distributions, and you need to be using your volume efficiently. All 3 of our community tokens are deployed, launched on Ethereum. 2 in particular, Survivor and Killer Whale, are paired directly with Ethereum. And our staking platform, Bullrun token, is paired with a stablecoin, USDC, so that its rewards, staking rewards, don't cause inflation. It's also scarce, not just deflationary, meaning that with every trade, whether it's a buy or a sell, its supply is shrinking. Which staking platform right now is out there in the market that is doing that, that is retaining liquidity, is accumulating USDC distributions to create a sustainable staking distributions for its stakeholders without causing inflation. And it's banning its supply, making it not only deflationary but scarce. And then it's using its volume efficiently to accumulate even more liquidity. This is exactly what's taking place, and this is the future. So whenever you look at the prices now, don't be carried away by today's price, because the future will reward those with strong fundamentals. And this is what this session was all about, to address those statements, this statement in particular, and to also address why the challenges we faced with right now, and how markets are artificially creating demand and volume, and who is involved, what is exactly happening, and what's happening December 19th next week with the Bank of Japan, as they're going to increase the interest rate, making it more expensive to have access to liquidity. And this liquidity was the one that is used on a global scale to purchase all these US assets. And all of these create a black swan event that is led by the Bank of Japan. And in order for us to be able to embrace the new, which is the blockchain technology led by Ethereum, which will lead us into a new monetary system on chain, we need the old one needs to break. So that's where we stand right now, community. And for us to position ourselves the best, we need to be on chain. We need to be already in it. And none of this is financial advice. These are my personal opinions. These are public informations out there. I'm just connecting the dots using public information, looking at the history, what's happening, and just verifying the statements, and ensuring that these statements, we can verify them and ensure that they are factual. They're not just here to make us feel good, but these are realities that are here to happen. So with that said, community, I want to wish all of us a wonderful, wonderful rest of the week. And let's not get carried away by what's happening in the short-term market with all this volatility taking place. But let's have the big picture in mind, understanding that it's for the future. And the future, you have to prepare yourself today for tomorrow. And the better you prepare yourself today, the better our tomorrow is going to be. With that said, community, thank you very much for being part of this session today. I want to wish you all a beautiful, beautiful rest of your week. And for tomorrow, Friday, there's a beautiful session taking place on Zoom for the Queens. And those who have not participated yet, I highly encourage us to do so. With that said, have a wonderful rest of your week, community.